Before this traffic light changes color, the United States government will have added another $500,000 to its national tab. Before you finish watching a few TikToks, it will have added enough debt to purchase a brand new luxury SUV. Before your coffee gets cold, it will have borrowed enough to buy a starter home somewhere in the Midwest. And the craziest part? Nobody in Washington is seriously trying to slow it down anymore. My name is Andrew Finance, and the number attached to that tab just crossed $40.2 trillion. The annual interest payment alone, just the interest, without touching a single dollar of principal, is now larger than the entire United States military budget. The last time America experienced that for a sustained period was 1935, before Social Security existed, before most baby boomers' parents were even born. This is not just another story about government deficits. This is the story of the exact moment a country quietly stops functioning like the country it used to be. So today, let me show you what just broke, why it matters, and what ordinary people can actually do about it. Now, here's the thing about the phrase debt crisis. It sounds dramatic. People imagine one giant financial collapse where the system implodes overnight like Lehman Brothers in 2008. But that's not what happened here. The explosion already happened slowly over the past 12 months, and right now we're all standing in the smoke pretending we don't smell anything burning. So let me walk you through the fuse. May 18, 2025. Moody's, the final major credit agency still giving the United States its highest possible rating, finally downgraded it. America officially lost its AAA status, something it had held since 1919. Think about that for a second. The country kept that rating through the Great Depression, through 2 world wars, through Vietnam, through the inflation disaster of the 1970s, through the 2008 crash, through COVID. But it lost the rating in 2025 because of peacetime math on an ordinary weekday afternoon. Treasury Secretary Mark Holloway responded publicly by saying, quote, "The global markets aren't worried, neither are our allies," which honestly sounded like someone yelling, "We're fine," while the house is actively on fire. Then just weeks later, J.P. Morgan Chase CEO Daniel Mercer, one of the few people alive who truly understands the plumbing of the financial system, stood on stage at an investment conference and said, quote, "You will see stress fractures in the Treasury market. It's coming, and when it comes, people will panic." Notice the wording, not maybe, not possibly. He said, "It is coming." Then July 4th, Independence Day, President Trump signs the American Prosperity Expansion Act. According to Congressional Budget Office projections, the bill adds roughly $4.4 trillion to deficits over the next decade, once interest costs are included. That's larger than the entire annual economic output of Germany. They called the bill historic. The bond market called it terrifying. Just days earlier, a Treasury auction quietly came in weak. And I know weak Treasury auction sounds like the most boring sentence ever spoken, so let me translate it into normal language. The United States government tried borrowing $25 billion. Out of every 5 expected buyers, only around 2.5 showed up. And the buyers who did participate demanded much higher interest rates before agreeing. Then, March 2026, China's reported holdings of U.S. Treasuries fall to $610 billion, the lowest level since 2007. So what did China buy instead? Gold. Massive amounts of gold. More than 240 tons in 1 year alone. More than the total reserves held by several European countries combined. They didn't simply reduce exposure to American debt, they started building a financial bunker. Then, May 21, 2026, the 30-year Treasury yield crosses 5.3%, the highest level before the Great Financial Crisis. 3 days later, newly appointed Federal Reserve Chair David Collins is sworn in. Standing beside him, Trump publicly says David will make his own decisions, totally independent, nobody tells him what to do, which sounded exactly like someone telling a dog not to eat the steak sitting directly in front of it. That was the fuse. Just 12 months. Individually, every one of those headlines could have been ignored. Together, they became the explosion. Now, let's look at the actual math, because honestly, the numbers are even more disturbing than the headlines. The total national debt now sits around $40.2 trillion. That equals roughly $301,000 per household in America, more than the average home price across most states. Your family's portion of the national debt could literally purchase you a suburban house with a driveway and backyard somewhere in the Midwest. Congratulations. And the number keeps rising. America is currently running annual deficits of approximately $2.2 trillion every single year, with no real long-term plan to stop. In fact, many of the proposed policies being debated right now are specifically designed to increase deficits even faster. But the scary part isn't the debt itself. The scary part is the cost of carrying it. In fiscal year 2025, the United States paid roughly $1 trillion in interest alone. Just interest, not reducing debt, not paying down principal, just the cost of borrowing money that was already borrowed years ago. Congressional Budget Office projections estimate that number could rise to nearly $1.9 trillion annually by 2035. Now, let me put that in perspective. That $1 trillion interest payment is larger than Medicare, larger than the entire military budget of the United States, bigger than every aircraft carrier, every soldier, every missile defense system, every jet fighter, every submarine, every military base combined. America is now spending more money servicing debt than defending the country itself.
We are now paying more money to bondholders than we spend protecting the country itself. Let me make that feel real for a second. Imagine a married couple living in Dallas, earning $152,000 combined, 2 children, normal suburban life. Between federal income taxes, payroll taxes, and everything else, they pay roughly $31,000 a year to Washington. Out of that $31,000, nearly $6,200 goes directly toward interest payments on the national debt. Not roads, not schools, not health care, not the military their nephew serves in, just interest payments on borrowing they never approved and debt they never personally created. So when politicians talk about making sure your tax dollars are being used wisely, what they really mean is making sure maybe 80 cents of every dollar is used wisely, because the other 20 cents is already spoken for before the money even arrives. And honestly, this leads into the most disturbing historical comparison in the entire conversation. There's a historian at the Hoover Institution named Adrian Keller. Earlier this year, he published a paper called Empire Threshold Theory. And the core idea is simple. Whenever a global power begins spending more servicing debt than maintaining military strength, that nation risks losing its status as a dominant power. He's not exaggerating. He's studying over 500 years of history. Habsburg Spain crossed that line during the 1500s and defaulted multiple times before losing control of its empire. France crossed it before the French Revolution. The Ottoman Empire crossed it and eventually fell under outside financial control. Britain crossed it after World War I and slowly lost global dominance over the following decades. Every major power that crossed this threshold either lost influence or had to dramatically restructure itself in order to recover. Every single one. The United States officially crossed that line in 2024. We are now in year 2 on the wrong side of it, and the gap continues growing larger. And Congress's response to crossing a 500-year-old warning sign that destroyed every empire before it? More spending bills, more borrowing, more celebration.
Here's probably the simplest way to understand all of this. Roughly 1 out of every 5 tax dollars collected by the federal government now goes directly toward bondholders, 20 cents out of every dollar. Back in 2021, the average interest rate on U.S. debt was only 1.49%. Today, it's closer to 3.37%, and about 1/3 of all federal debt has to be refinanced every single year using current interest rates, meaning old cheap debt keeps getting replaced with expensive new debt, and the interest bill keeps growing automatically. That's not a prediction, that's just arithmetic. Now, if you've stayed with me through all the numbers, here's the part that should probably make you angry. If America owes nearly $40 trillion, who exactly owns all that debt? Increasingly, Americans themselves. And honestly, that should not comfort you, it should worry you. Foreign countries currently hold around $9.4 trillion of U.S. debt. That's significantly lower than 2008, when foreign governments owned roughly half of all marketable treasury securities. Today, they hold less than 1/3, and the percentage keeps falling. Japan remains the largest foreign holder at roughly $1.19 trillion. China sits around $652 billion after years of gradually reducing exposure. Meanwhile, American pension funds, banks, and money market funds are buying larger portions themselves. We are increasingly financing our own debt internally, which sounds patriotic until you remember that countries like Argentina followed a very similar path before things went sideways. And here's the part mainstream headlines barely discuss. The government is actively trying to create entirely new buyers for Treasury debt. Last summer, legislation called the Digital Stability Act was signed into law. The bill requires stablecoins, those digital dollar tokens used heavily inside crypto markets, to be backed primarily by short-term Treasury bills. Treasury officials estimate the stablecoin market could eventually reach $3 trillion by 2030. Think about what that means. America effectively created a brand new mandatory buyer for its debt by law. That's basically like a struggling restaurant losing customers, then convincing the city government to require every resident to order takeout twice a week. Bold strategy, definitely no possible side effects there. Now let's look at what professional investors think about all this. The Bank of America Global Fund Manager Survey from May 2026 questioned roughly 200 institutional money managers, collectively overseeing more than $500 billion. They were asked where long-term Treasury yields were headed next. About 62% predicted the 30-year Treasury yield would rise towards 6%. Today, it already sits near 5.19%. The people whose careers depend on understanding bond markets believe rates are still heading higher, not lower. And then there's gold. Gold crossed above $5,000 per ounce earlier this year for the first time in history, up more than 25% since the beginning of last year. Central banks are purchasing gold at the fastest pace seen in half a century. Now, remember something important. Gold produces no cash flow. It pays no interest. It doesn't innovate. It doesn't grow earnings. Gold basically sits quietly inside vaults doing absolutely nothing. So when the smartest institutional money in the world chooses a shiny metal that pays nothing instead of treasury bonds yielding 5%, that's the financial system quietly voting on the future of the US dollar, the politest no-confidence vote imaginable, like hearing a smoke alarm in the next room while everyone pretends somebody just burned toast. So, how does this actually end? Historically, sovereign debt spirals only end through 4 possible doors. Let's walk through them. Door number 1, austerity. Simply cut government spending. The Committee for Fiscal Stability recently estimated that stabilizing America's debt trajectory would require spending cuts and tax increases totaling several trillion dollars over the next decade combined. And politically, almost nobody wants that conversation.
What would it actually take to stop America's debt from growing right now?
According to the Committee for Fiscal Stability, stabilizing the debt at today's level would require roughly $827 billion every single year in permanent tax increases or spending cuts forever. And here's the crazy part. $827 billion is almost identical to the entire U.S. military budget. In other words, America would basically need to erase the Pentagon from existence or do something economically equivalent just to stop the debt from getting worse. Not reduce it, not pay it down, just stop the bleeding. Now show me the politician campaigning on, "I will eliminate the Pentagon to balance the budget." Exactly. That door is locked. Door number 2 is growing our way out. The theory is simple. If the economy grows faster than the debt, eventually the debt becomes smaller relative to GDP. This actually worked after World War II, when America averaged around 3% economic growth annually. But today, the Congressional Budget Office projects only about 1.6% average growth over the next 30 years, one of the weakest long-term forecasts in modern American history. What does that mean in practical human terms? A child born today may grow up inside an economy that barely feels richer per person than the economy their parents experienced. Their grandparents' generation saw the economy roughly double during their working lives. Today's younger generation is projected to experience only around 50% growth across the same time frame. A lot of people assume artificial intelligence will solve this. Maybe eventually, but right now, AI has contributed only around 10 basis points annually to productivity growth. We're going to need a lot more than chatbots to outrun a debt spiral this large. So door number 2, mostly locked. Door number 3 is default, simply refusing to pay the debt. Technically possible, realistically catastrophic. The moment America defaults, the US dollar risks losing reserve currency status. Savings accounts get destroyed, global trade freezes, financial markets implode. No serious policymaker truly wants this scenario. That door stays locked through mutual self-preservation, which leaves door number 4, the one nobody likes discussing publicly. Inflate the debt away. Print more money, allow prices to rise, repay $40 trillion using future dollars that purchase less and less over time. The official term for this strategy is financial repression. The cleaner version is keeping interest rates below inflation long enough for debt to slowly shrink relative to the economy, while everyone pretends nothing unusual is happening. Britain already lived through this. Back in 1976, the British pound started collapsing in real time. The IMF effectively arrived like financial repo men. Ordinary citizens watched their purchasing power disappear at gas stations, while government officials insisted everything remained under control. Britain spent decades slowly grinding through the aftermath. In many ways, they still are. And this is where things become really interesting. Ray Dalio, founder of Bridgewater Associates and one of the most successful macro investors alive, publicly stated this year that America is heading toward what he called a debt-induced heart attack within roughly 3 years, give or take. And according to Dalio, the ending is not default. It's door number 4. The Federal Reserve eventually prints money, purchases debt the market no longer wants, and slowly weakens the purchasing power of the dollar until the debt burden becomes mathematically smaller. He said it openly. The people running the system cannot say it openly. But when 3 of the 4 exits are effectively blocked, eventually everyone starts walking toward the only remaining door. Now, let's bring this back to normal life, because I know what most people are thinking. Okay, interesting macroeconomic history lesson, but I've got a mortgage, retirement accounts, and kids. What does this actually mean for me? A lot more than most people realize, and honestly, most of it has already started. Imagine you and your spouse sit down tonight searching for houses. You find a beautiful home priced at $450,000. At today's mortgage rates around 6.5%, your monthly payment, including taxes and insurance, lands somewhere near $3,400. Now compare that to someone who bought the same house in 2021 at around 3%. Their payment? roughly $2,550. That's an $850 monthly difference, more than $10,000 extra every single year. Over 30 years, that becomes roughly an extra third of $1,000,000 in interest payments. Same house, same neighborhood, completely different financial reality simply because of timing. The debt crisis already entered the housing market years ago. It just disguised itself as a mortgage payment. Freddie Mac currently reports average 30-year mortgage rates around 6.51%, and the Mortgage Bankers Association expects rates to remain in the 6% to 6.5% range through at least 2027. That higher payment environment is probably not disappearing anytime soon. And then there's Social Security. If you're roughly 50 years old today, here's an uncomfortable thought experiment. You'll likely hit retirement age almost exactly when the Social Security Trust Fund becomes depleted. According to the 2025 Trustees Report, that happens in 2033. The moment that fund runs dry, incoming tax revenue only covers about 77% of promised benefits, meaning checks would effectively shrink by around 23% unless Congress intervenes. Not theoretically, not hypothetically, literally written into the current math. And lawmakers have known about this problem for decades, since the people funding the system today were children. The Medicare Hospital Insurance Trust Fund is also projected to run dry in 2033, after trustees moved the timeline forward by 3 years in a single report. If you're younger than 35 years old, your entire working life will probably exist inside this era of debt repression. Higher taxes, lower real returns, gradual purchasing power erosion. If you're older than 50 years old, retirement itself may arrive directly alongside trust fund instability. Nobody escapes this perfectly. The real question is simply whether you recognize it early enough to prepare. Now here's the important part. This is where you can actually do something. None of this is financial advice, but pay attention to what serious investors are doing right now. Ray Dalio recommends holding roughly 10 to 15% of portfolios in gold. Stanley Druckenmiller reportedly holds major positions betting against long-term treasury bonds. Warren Buffett is currently sitting on more than $325 billion in cash equivalents. The most experienced investors in the world are preparing for instability. They could absolutely be wrong, but you don't need to believe a storm is guaranteed to justify carrying an umbrella. So what are people doing? First, many are holding 10 to 15% in gold, not because gold magically creates wealth, but because it acts as insurance against currency weakness. Gold does nothing productive. It simply exists quietly while central banks around the world continue to buy it aggressively. That alone should probably make people pay attention. Second, real assets. Real estate that produces cash flow, businesses with pricing power, companies capable of raising prices alongside inflation, broad index funds containing those businesses. For safer portions of portfolios, many investors prefer shorter duration treasury exposure around the 5 to 7 year range, instead of locking in to 30-year bonds at current rates and hoping inflation disappears. Treasury inflation-protected securities and I-bonds also function as direct inflation hedges. I-bonds currently cap purchases at $10,000 annually per person, which sounds restrictive until you realize married couples can buy $20,000 combined. And maybe most importantly, don't panic. America is not Argentina. This is not Weimar Germany. This is not even Britain in 1976. The United States still has enormous economic power, innovation, military strength, and global influence. But what is probably ending is a specific era, the era of permanently cheap money, the era where borrowing felt free, the era where people assumed $40 trillion of debt simply didn't matter because markets kept functioning normally. The cracks are starting to show now. The explosion already happened slowly. Most people just haven't noticed it yet. And honestly, that still gives you time. Use it.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.